Welcome to transmission number 30, today with Reggie Middleton and his new project. So, Reggie, thanks for coming on today.
Very welcome.
What is the name of your new rebranded project?
Veritaseum.
Veritaseum. And how did you come up with that name?
Well, um, in finance in general, especially over the last, I'd say, 10 some odd years, but maybe over the last 30, a very negative connotation has been attached to it. Duplicity, rent seeking, uh, liars. So I decided to come up with a new way of doing things. If you look at a lot of other videos and the mainstream, I wanted to build a financial system on top of the Bitcoin blockchain. This new financial system would be different. Transparency, truth, incorruptible asset uh, holding. And so Veritas, which is a Latin term for truth, and I didn't take Latin if I'm butchering it, but as I understand it. So the element of truth, Veritaseum, which is something I came up with when I was asleep, I decided to rebrand and call the venture Veritaseum. Initially, it was called UltraCoin. That caused some confusion because this is a pure Bitcoin project using Bitcoin script over the Bitcoin blockchain, with Bitcoin as the actual transmission mechanism, unit of value or token. But calling it UltraCoin caused a decent amount of confusion, at least in the Bitcoin community. So, as the element of truth, Veritaseum it is.
Okay, great. All right, well, I have the client and I've tested it out a little bit, and I guess the easiest way for me to explain it is it's a peer-to-peer derivative platform where I can, go long or short on different things as long as I find someone else on the marketplace, and through a smart contract that's on the Bitcoin blockchain, everything is done there. Is that a good short summary, or how could you add to that?
It's a good short summary. Uh, Not much to add to it, just possibly expound for the reasons. The reasons why we use smart contracts is we wanted to make the process incorruptible and automated, self-executing, self-enforcing. So once you decide to enter in a contract, and a contract can be anything with a public data feed. When we use publicly traded securities, you have over 45,000 tickers to choose from in any combination. If you use tickers that are traded as pairs, primarily Forex, you could now trade four securities at one time, one transaction, with one very, very low transaction fee. Once you put this into the blockchain as a smart contract, the reason why we're using Bitcoin blockchain is the fact that it's, as of right now, unhackable. So there is no default risk, there's no credit risk, there's no counterparty risk, there's no exposure to the balance sheet of a broker or an exchange or an unknown party. So this is truly a zero trust or a low trust transaction, depending on how you look at it.
Okay, well, let's back up just one step because some people watching might not be traders or might not really understand what derivatives are. And also, a lot of people have a very negative, when you say the word derivatives, they automatically have a very negative, yeah, that's a very negative word for them. So, what is a derivative?
A derivative is almost anything that people come in contact with from a financial perspective. The negative connotation that derivatives have received are pretty much a combination of media, misinformation, and disinformation. Not necessarily on purpose, but it does happen. And the ignorance that comes from it. And not ignorance in a negative light, but ignorance in not knowing. For instance, most people don't know that the US dollar was a pure derivative up until 1973 with Bretton Woods, where US dollar was supposed to represent a unit of gold that was at some point allegedly redeemable. But whether redeemable or not, the US dollar was supposed to be backed and floated against that particular unit of gold. As of right now, today, the fiat currency, the US dollar, is still a derivative. It's a derivative that is backed and represented by the military might and the full faith of the government. So a derivative, by definition, is something that derives its value from something else. Very, very few financial assets or commodities are not derivatives because the only things that don't derive their value from something else are things that have their own intrinsic utility value. So gold has intrinsic utility value as a high conducting metal. Okay, but gold trades at a significant premium above that utility value because of its derivative value, what people, assume it would be from a fiat perspective would derive. And we could go on. So what makes a derivative a bad thing is when derivatives become overly complex. Derivatives become overly complex because the makers of derivative want to pack significant profit margin in. And the less you understand about how it's priced, the more they can price it. And that's,
Hmm.
the danger of the derivative trade, and it could get significant. But that might be
Okay.
beyond the context
Yeah.
of the show.
Yeah, but that's a no. But I wanted to go over that because a lot of people, I think, are gonna be thinking about that, and I think, yeah, what you said is if it's too complex and you can pack a lot of crap on there that maybe someone doesn't want to have. I want to put my trash in there and hand it to you, and you
Right.
don't really notice it basically. Okay, well, since this is more transparent and on the blockchain, I guess it's pretty difficult for that to be done. So I like that aspect of it. And if Matt is ready, I would say we just go into it, and you can talk about how we could do that. I mean, I have the client. It's a kind of Bitcoin wallet. It's a light wallet, so it doesn't you don't have to kind of like multi-bit or Electrum. So it's pretty quick to use. It's lightweight, and you can then go through the different markets and see what's offered, and then you can take a position. You can, if you go long, you think it's going to go up, and if you think it's going to go short, it's going to go down. But you guys can explain some of the more complex things you can do that are really interesting. Um, that you could do here, and that you might not be able to get at your standard broker. And if you were to get it from the standard broker, it would be very expensive in fees. Matt, are you there?
I am, and now unmuted. Sorry about
Okay,
that.
it's okay.
Just
Yeah, I
just
know.
along, just to piggyback on the derivatives discussion a bit. A lot of people don't realize that derivatives are actually just to demonstrate their non-evilness. Most insurance products are derivatives. Like if you purchase fire insurance for your home, that's effectively a derivative. So it's not, we spend a fair amount of our lives hedging our own risk using these types of things. So they've gotten kind of a bad rap for the probably some subset for a well-deserved reason because of the types of things that Reggie's talking about. But as far as our modern economic world, they're kind of essential. With respect to our client, it's you're right. It's relatively simple as far as wallets go. We have basic wallet features that you would come to expect. The ability to receive and send coins. Not much yet past that, although things are in the works. Things are coming. But one of the things that we do that, as far as we know, nobody else does, is allow you to trade exposure to the change in price or perceived value of pretty much anything that you want that is a tradable instrument on pretty much every exchange in the world. One of the things we were talking about earlier is a particular trade that came up recently, is the swapping of exposure to I think it was a Sandridge, right? Sandridge Energy Corporation, which I don't want to say it's a penny stock. It's not. It's not a pink sheet stock, but it looks lightly traded to the U.S. dollar in terms of Bitcoin. And so uh, this is a view using Yahoo Finance, for example, over the past 24 hours of what the relative changes in value of that particular trade are. Now, to set this up in a traditional brokerage, if you wanted to go long one of these and go short the other, it's a relatively complex thing, just in the amount of paperwork that you would need to open the account and establish the fact that you were savvy enough to be able to trade these things long and short, you also have other things to worry about, such as margin interest and carry and all that kind of stuff. And Reggie is a much better explainer of that than I am. One thing that, just to illustrate a point, one thing that used to be a fairly reliable arbitrage trade, and don't ask me to explain why, because I have no idea. I'm sure there are smarter people who can identify the potential reasons for this correlation. But it used to be the case that the Aussie dollar Japanese yen pair tracked the S&P 500 E-mini futures really, really closely. They were very highly correlated. And during the off U.S. market hours, primarily in the Asian market hours, trading sessions, those two things would diverge, and they would almost always sync back up at some point. Now, you didn't know whether the high asset was going to drop or the low asset was going to rise, but it was a fairly high probability trade. Again, I don't know if this is still the case, so I'm not advocating that people do this without investigating it thoroughly. But to set this up using traditional accounts, what you would have to find is somebody who allowed you to trade the Aussie dollar Japanese yen pair in an amount that was suitable to your capital risk and risk tolerance and that kind of stuff, and also find a place where you could trade the S&P 500 E-mini futures in a volume or quantity that was compatible. In other words, you want roughly equal amounts on both sides, because what you're trying to take advantage of is an arbitrage. So you can't, you don't want to introduce risk by basically doubling one side, or having there basically be a skew of one side to the other. And I realize this is probably complicated for most of your listeners, but the simple version is basically the lines of these things would look the same until they didn't late at night in the US. And when they diverged, you probably wanted to jump on that and wait until they hooked back up again, and then you would get your money. So, but the requirements to actually do this, the account requirements, were pretty staggering, and you had to do some fairly heavy lifting mathematically to make sure that the amount that you put into one side of the trade mirrored the amount that you put into the other, so that it would work. We make that actually very, very easy. This is the you're looking at a chart of the of basically the E-mini 500 futures and an index, because it fills in kind of missing market information. That's the red and green line, and then the blue line is the Aussie dollar Japanese yen pair. You can see that the lines are actually pretty similar. This is not something I trade right now because it's over the weekend. You don't get, and the Asian markets aren't going to start up until tonight, but and where you would observe that kind of divergence, if any. But you can imagine a situation where these two lines would kind of blow up against each other, or they would expand a lot. And if you wanted to take advantage of that, let's say the E-mini went up and the Aussie dollar went down, what you can do using our client is basically you're betting that either the Aussie dollar Japanese yen pair will come back up, or the S&P 500 E-mini future will come back down, but you don't really care. Either way, you want one of those things to happen, or some combination of each to happen, but you want them in appropriate amounts to the point where when they converge again, you get paid. So the way that you do that with our client is you download the client and you fund it with Bitcoin. You don't have to fill out paperwork. You don't have to open 3 accounts. You don't have to call Interactive Brokers and try and enable 3 different things on your existing account and explain, how you're savvy enough to do this. But basically, what I've done here, I don't know if you can see this, but I'm making a very small bet where I am betting that the Aussie dollar Japanese yen pair will rise, and that the S&P E-mini futures price will fall, and I want I want to set that over a period of time. Now, you can put in a standard time here, like let's say 5 hours, um, but that's what you can't do with this particular field is set when that 5 hours starts and when it stops. But that's okay because you can. For me, I want to have some precision or control over this, so I can find that in the advanced panel. And what I typically would want to do in this trade is end it before U.S. market hours on Monday, and I'm in Pacific Daylight Time right now, so that I might pick 4:55 a.m., which translates into just before 8 o'clock Eastern Time, and then that would be when I want the trade to end, and then when I want it to start might be Sunday night, say around, I don't know, 9, 10 o'clock Eastern Time, so that would make it 6, 7 o'clock my time, so let's call it 6:30. Now, one of the, and if I just clicked OK, then that would be fine. One of the features that we have added recently is the ability to effectively amplify the price action, and we call that leverage, although it's a little bit of a misnomer. But basically, it's how much I want my initial bet to behave like it is. In other words, I'm betting 5/100ths of a Bitcoin. But if I wanted that to behave like half of a Bitcoin, for example, I might dial in 10x the leverage. Now, there's a warning here. Increased leverage means increased volatility, and I could lose this bet fairly quickly. But assuming that this met my analysis criteria, met my risk tolerance, I can now basically amplify the return up to a fixed amount, up to the amount that I'm risking. So I can never win more than basically what I'm betting, or what the other party is betting against me. But now I have a lot more precise control over the behavior of those prices and the timing of it. And once I've done that, I can basically create a new order and place it on our system. And it will show up in my trades list as funding until the appropriate blocks can be mined that put that trade into action. And when that happens, if other people open the client and they come to the market screen and they hit all market orders, that my order will show up here and they can take the other side of it. Assuming they do, then we're in the trade, and hopefully I win, and hopefully they lose. But you can see by my trades that I'm not doing so well with the 3 outstanding ones that I have right now. So no guarantees there. But that's kind of a brief overview, or a kind of a simplistic introduction. Well, actually, it's not simplistic. It kind of gives a tour of some of our advanced features.
Yeah. So these are those positions that you showed us. They're on the blockchain right now, right? They're on a kind of like a multi-signature smart contract that is. So I can actually track. I can go and find that on the blockchain and see a little bit of what you guys have entered into, right?
Absolutely, and it's actually fairly easy to do. I can select any one of my trades, and if I click the Track Transaction button, we send you to a web page on blockchain.info for regular Bitcoin. If you're using testnet, blockchain.info doesn't have testnet information, so we can go to a different website. It doesn't matter. But you can see they both have roughly the same information. But you can see right now the actual transaction that is being used to fund that order, and you can see that as of yet it's unconfirmed, but that will change as soon as the next block is mined for those of your listeners who are Bitcoin savvy. But you can see basically the amount that gets funded in a multi-sig transaction, and what will happen with this is that it will basically be committed into a second transaction on the blockchain, and I can show you that via one of my existing trades. This is actually one that I did with myself, kind of as a test. But if I track that transaction, this looks similar to the previous screen, except that the transaction's been confirmed. And if I look at this this escrow transaction, sometimes called multi-sig among Bitcoin aficionados, you can see that that multi-sig transaction has been spent. And if I click on that spent link, it will take you to the second transaction in that chain. And this is where the basically the funds are committed and locked up for the duration of the trade. And there are three individuals or three parties that can basically end this trade. One of them is us, one of them is party A, and one of them is party B. And you need two of those parties to agree for that trade to be over. And what we do on our side is that when we observe that that trade is exhausted or has completed, we value it, and then we send both parties basically our okay or our signature given certain parameters that allow for that trade to finish and people to get their coins out. And then either of those parties can provide the second signature and broadcast it. But this is, I mean, you can kind of see the auditability of what we're doing here. So you can track from the time that you fund the transaction all the way to the time that you get your coins out. It's all visible, it's all there, there's nothing hidden. It's pretty out in the open, and we want it that way, we like it that way.
Okay, well, I have a quick question. So, where does the info come from? Where's the data feed for the prices? Is it from you guys, or is there a third-party API, or how does that work?
So currently oh, sorry, go ahead, Reggie.
Go ahead. Ask if you want to take it. Go ahead.
All right. So currently, what we do is we get historical price data from data feeds for tradable instruments with ticker values, right? So we get price feeds for these things that could come from any number of sources, right? Ultimately, things listed on the NASDAQ come from NASDAQ, and et cetera, and they're filtered through a third party, and that's where we get our information. What is interesting is that it doesn't necessarily have to be tickers. We're limited to tickers now in tradable markets, but we are looking at ways of trading things that aren't tickers. And I'm reluctant to say too much about that until we kind of get things out. But the data does come from an independent third party that can be verified by anybody. I mean, you can go look at historical price. Like, let's say you're trading a NASDAQ ticker. You can go look at the historical price data and see see that it matches up with what we're claiming happened, et cetera.
Okay. So the positions, or Reggie, did you want to add to that?
I just wanted to add quick things. Matt, if you could just go back to your wallet and click the trades and just click completed trades to see what this looks like. And there's in the Well Club, I visited several times, and when I'm talking, I don't get to read a lot of the questions that I ask. But afterwards, I see the questions, and there's some speculation as to what this is. I can tell you what it is basically it's a newfangled form of a swap, a digital swap. Basically, you receive any exposure, and then you pay an exposure, receive that exposure. So you buy something and pay something in return. That's basically what this is. It's the essence of a swap. More importantly, it's to discuss what it's not. It's not a CFD. CFDs are illegal in the United States. They may not be illegal if they're done OTC, over the counter, but that's not a relevant discussion here because these are not CFDs. Okay, these are not binary options. Binary options and CFDs are relatively rudimentary vehicles that are limited in both payoffs and the potential complexity that can be put together. For instance, a binary option is an option that, or the simplest binary option, is all or nothing. Basically, it's either on or off. If a price pierces a certain barrier, you get paid, and if it doesn't, you don't get paid. If they have what you call a discontinuous payoff. So if you're going long Apple, short US dollar, basically you're buying Apple exposure and you're paying dollars for it. If Apple goes above 120, then a binary option will pay out. And if it doesn't, then you lose all your money. A lot of the binary option implementations that I've seen, outside of being rudimentary, are also very hard to make money on because the pricing is, significant relative to the potential payout. And since the potential payout is fixed, uh, you know, very little profit to be made. With a swap, you have what you call a continuous payout curve, where this swap, if you were to go long Apple exposure, short USD, or long Apple exposure, short Euro, that would be buying Apple with Euro dollars, with euros. Going short USD would be buying Apple with dollars, or you can buy Apple and pay Google. So you're basically buying Apple with Google exposure. That's essentially two equity trades, equity exposure trades at the same time. But the point is, if Apple goes up, if you look at Matt's screenshot where Apple went down 1.25%, your trade goes down exactly 1.25%, continuous payoff, where a binary option is 100% of zero minus fees. So continuous payoff curves are very important because it enables you to make granular, specific bets on underlying. Number one, and number two, if the curve goes against you but doesn't exhaust all of the capital at risk, you're still in the game. So it could go against you 30% and then go up in 40% and you're 10% in the money. And once your trade expires, you're up 10%. So these are not binary options. These are not CFDs. These are a new implementation of the essence of a swap. And anything's a swap. So when you go to your broker and you buy 100 shares of Google, okay, you essentially are swapping US dollars for Google stock or Google stock exposure, shall I say, because very few people take certificate deliveries in the bank. So I just wanted
Okay,
to make
great.
that clear.
All right, I like that. Yeah, so these don't have knockouts or anything like that, where like a binary, like you said. It's a different concept. I like that. That's very interesting. So one reason it really interests me is that this is opening the access for these swaps to anyone basically. All you have to do is download the client, and you don't have to, like you said, fill out all kinds of paperwork or go through a credit check or I don't know what other kinds of things you might have to do. So anyone can hedge their risk, whether that be investment risk or I guess potentially, I guess real life risk. So I guess potentially I could hedge heating oil for my house. So I want to hedge the risk that the price is going to go up, or gasoline in my car, or oil or something, because I'm going to need to use that. So that's a potential use, right, for everyday people.
Absolutely. Matt, let's walk into a quick hit right now of oil, where we'll receive OVX, okay? That is the oil volatility index, and we will pay out the euro. Let's assume that you're in Frankfurt, you want to hedge oil volatility, and you're a euro-denominated player. So you receive OVX, that's OV, like Victor. You receive OVX exposure, you pay EUR/USD, so that's a euro-dollar cross, okay? And you have the option of levering up if you want, turning the multiplier effect up, so you can exaggerate the leverage effect. So you don't have to put as much capital out as you normally would. Let's say you wanted to hedge $100,000 of exposure, 100 and, say $110,000 of exposure, which would be roughly about $100,000 euro. Okay, you could put $10,000 right up. You turn the leverage up 10 times, and now you have hedged 100,000 euro worth of exposure with $10,000. In terms of, and the hedge would be the volatility of the oil index. The OVX is the volatility of the Brent crude index. You can do that very quickly. Now, the other side, you need someone else to take the other side of the trade. And a question I get from a lot of institutions that I show this to, that that's all fine and good. I like it. It's granular, it's specific. You have a lot of flexibility, but we don't want to take Bitcoin volatility risk. We don't like Bitcoin pricing. It's good for speculating on the actual Bitcoin itself, but if you want to hedge oil volatility, Bitcoin price volatility brings in a dimension that we don't want to be bothered with. Well, that's when leverage comes into play. Okay, when you turn the leverage up, you basically outrun potential Bitcoin price volatility. So we're going to do this trade, OVX, oil volatility, Brent crude volatility. We're going to receive that. We're going to pay the euros for it. You lever up 25 times. Okay, that means that for every unit of Bitcoin price volatility, you get 25 units of the hedge that you want, which effectively quells the effect of the Bitcoin price volatility. So you mitigate price. And the higher you turn the leverage up, the less you feel the Bitcoin volatility effect. Anything over 20, 25 times pretty much smooths it out. You could turn the leverage up to 75 times or 80 times. You can actually, at 65 times, you could take a 40% price loss. So Bitcoin could drop 40% during the duration of this trade, and you still come out positive. Assuming you're on the winning side of the trade, of course. If you lose the trade, you lose the trade.
Yeah, sure.
No amount of financial engineering magic does that.
Yeah, but the idea is that, I can hedge and I don't have to be some kind of super banker or, really in the know person. Anyone can download this thing and I can hedge my risk. And that's just a safety mechanism that a lot of people do take advantage of for their investments, but the general public is sometimes left out of, or for different reasons because of different regulations and also know-how. And I think this has the potential to make it, the access greater for people to hedge their risk.
Let me add on to that. The access is significantly greater. If Matt, you could go back to the wallet again. You can put a very large amount of capital in, or you could put a very small amount. Right now, this is measured in U.S. dollars. Matt, if you can switch it to euros, switch the currency translated to euros. Okay, let's say we have a very, very smart 11-year-old kid in the Czech Republic. Okay, rural, lower income Czech Republic. He wants to do 0.001 euro. He can actually do a trade that low and potentially profit off of it because the fee is actually low enough where he could profit. So you can do 1/1000th of a euro trade and any of these 45,000 tickers or so, and you could do it profitably if you're on the right side of the trade. So from a very granular micro transaction up until, the sky's the limit on the upper side, definitely over the millions. Just need somebody to take the other side of the transaction. And by using the leverage option, you can assume you had more at risk. So you can actually get the price movement of a larger amount. This 11-year-old could take that 0.001 euro, do 100 times leverage, and now he's trading a whole euro. Oh, a tenth of a euro. Excuse my math, but
yeah, that's okay. That's cool. All right. Well, this is great. So the fees that we're talking about, they're just the minor fees, right? For the Bitcoin network.
Well, the minor fees, and then you have to pay the fees for the actual transaction. What we do is we took the lowest possible price of any brokerage. We dropped a few basis points off of that. So the maximum fee you could pay is 25 basis points, and that's for a round trip. Because remember, these are swaps. So a 25 basis point fee is the same as paying 12.5 basis points per trade. Okay, that is very, very low. If you go to Charles Schwab, if you go to Merrill Lynch will charge you maybe 3%, 4%, 5% for the same thing. So between 300 and 500 basis points versus 5 basis points. 12.5 basis points. That's on the high side. On the low side, it falls down to about 5 basis points per trade, 10 basis points round trade. The multiplier effect, the leverage, taps out at about 80 basis points. Nobody can borrow money at 80 basis points. That's what Goldman Sachs does, the central bank. So and this is for all asset classes and all tickets. These prices may seem average or so-so to forex traders, right? They're outrageous once it comes to trading gold, platinum, silver, oil, stocks, or commodities.
Reggie means outrageously low.
Excuse me?
I said Reggie means outrageously low.
Yes, outrageously low, yes.
Yeah, yeah, I get it. Outrageously low, yeah, not just outrageous. Yeah, okay. So it's access to everyone, and it's outrageously low fees when you compare it to any other broker that would do anything similarly. And I can also build really exotic swaps that are really complicated. Correct?
Correct. You go
if I
from
want
very
to.
simple to very, yeah. For instance, you can quickly do forex pairs. So you can trade suppose you're a Kuwaiti sovereign wealth fund and you're concerned about oil exposure. So you could take the Kuwaiti currency, I can't remember exactly what it is, and you could swap Kuwaiti US dollar forex pair, okay, since oil is priced in US dollars, and you can sell that for Euro Korean won pair. So that's if you're shipping oil off to Samsung in Korea.
Yeah, okay, that's great. All right, well, I also want to talk about, some other things. So you guys are launching a token to that's based on the how can I explain? It's based on your work. So it's not an equity token, and it's not a standard crypto coin. It's you could use it to redeem hours of consultation from your company. Is that correct?
Mm. Okay.
Hold on.
Can you hear me?
Now you're
Okay.
good. Now you're good.
Yes, that is absolutely correct. What it is a token that we call the capability commodity. And basically, we wanted to encapsulate the talent of our team, which is very diverse for a small startup. Matt Bogosian, the guy who's doing the screenshots, is our chief technology officer. He's an experienced software engineer, architect, who's worked on the payment teams of Amazon, of Yahoo, of Grand Central, which was purchased by Google. A portion of it was purchased by Google, became Google Voice. He's also a practicing member of the bar, an IP attorney and patent attorney, an expert in intellectual property and contracts. You can't do better than that to make a smart contract engineer, an actual software engineering intellectual property lawyer. Myself, I talk a lot, so I'm good at that. I've been known for making a lot of calls in the past. I've called before with Bear Stearns publicly through research put up my blog. 3 months before they collapsed, Lehman Brothers, General Growth Property, Countrywide, the European debt debacle, Ireland, Portugal, about 86 altogether over the last 7 years. My strength is I'm a contrarian forensic analysis. Basically, I look at things and I tend to see things in a different light from others, which caused me to jump on a Bitcoin smart contract gravy train, about 2.5 years ago or so. We also have very strong programmers, little geniuses. I'm very happy to have these guys on board. Financial analysts and forensic accountant that I've been working with for the last 7 to 8 years. And this team, and as we grow, others are basically out for hire for people who have an interest in either this decentralized architecture or the financial forensic and macro analysis and or trading strategies that we offer. There's basically three different tranches, that we specialize in, with I guess the IP portion being a third and a half tranche. So we sell the Veritas, which is basically a commoditized token that represents our services, and that token can be traded freely amongst anybody else. It will actually be on the crypto exchanges, so you can sell it back and forth. Consider it a gift card, like a Macy's gift card, but instead of redeeming it for stockings or purses, we redeem it for the intellectual capital that backs Veritaseum. If I'm not mistaken, and I very well could be, I believe we were the first to come out with the broadly available multi-signature wallet. We were the first to come out with a smart contract aware wallet, and we were the first to do decentralized derivative trading, especially at this level, with 45,000 tick rates, etc. So we were pretty early to the game. I believe, hopefully, that there's considerable valuable having access to the team. Now, we'll only advise or consult on our platform, but our platform is very, very flexible. We're just working on trading venture capital exposure. So institutions who want access or exposure to the venture capital space, particularly the venture capital space, as opposed to Bitcoin companies and decentralized access, we can actually build that for you through our platform. And you don't pay 2 and 20. You get direct exposure. You pay no fees except for the basis points that we discussed, and it tracks granularly and specifically. So, Interesting times, exciting times. We could build that for you in exchange for purposes of Veritas. We can also put strategies together. We can take your current implementation and we can tie it into our API, so you don't even have to deal with our software. Basically, API driven. Think of Google Maps.
So I
Matt, did you
wanted
have any?
what I don't know if Matt wants to add to that, but I wanted to ask, so is the value one of these tokens fixed to like 1 hour or 1 minute or whatever? And are you guys going to only do consulting for these tokens, or what if people want to pay you in, pounds or dollars or whatever? I'm just saying this because I want to see the try to measure the value, the speculative value, or just the value of these tokens. If it's set. I mean, if it, I would just say, okay, well, it's cheap to buy the tokens. I'll just go buy the tokens. The tokens are high. Well, I'll just pay you, eat my fiat. You can have dollars. You see what I mean? So,
I'm
if it
sorry.
was, yeah, if it was set, then I would say, well, okay, well, that's a little different. Then it's a different game. So, how is that going to work?
So first and foremost, and I wanted to mention this earlier, we're a software company. What it looks like we have a fancy exchange and derivative platform is not the case. This is a decentralized peer-to-peer-ish exchange. We're a software company, so you don't have exposure to our balance sheet like Bear Stearns or Merrill Lynch or Mt. Gox. You don't have to trust us, and you don't have any counterparty credit risk. With that being said, as a software company, we're a software company, so we're not a consulting company either. Um, what we want to do is we want to incentivize and increase acceptance and exposure of our platform and teach everybody. So we will consult with and advise anybody, but in order to get our consultation advisory services, you have to buy Veritas. Veritas are like the gift card. Okay, but Macy's takes fiat, we take gift cards. If you have a lot of fiat, I strongly suggest you go buy Veritas with it, and then you can redeem it with us.
Okay, great.
But we don't.
Okay, well, that explains it. So that also ties in a little bit. So tell us about your evaluation concept of tokens and altcoins. So I believe on the website, you have these criteria that you've kind of mapped out where, let's see, I'm looking at Matt's screenshot. I'm not sure exactly where it is, but it was an interesting concept. So you're kind of like saying, okay, you've got to evaluate what you explain, who the people are. Um, you call altcoins businesses basically in essence, and you're evaluating what the value should be for these things. Here we go. The what was it? Crypto token evaluation method. Value. There we go. So how did you guys come up with this? And I mean, of course, yours is going to be valuable because you guys made it, but Uh, but I liked that you did that you created a clear concise. You said, okay, this is the reason that I think that these are a clear explanation of why these tokens have value or don't. So I don't know. Could you kind of explain what you were thinking when you were developing that?
Okay. Well, first, let me give you a theoretical groundwork. In, in simple layman's terms, any venture, right, is usually, well, actually, all ventures have an economic goal. Okay. Um, that economic goal may be a social economic goal. In other words, you could create a charity that wants to feed the rest of the world. Or it could be more of a financial goal, such as to make money or to increase the value of a particular asset. Crypto tokens and most of the ventures have economic goals, in my opinion. And, let's not shy away from it. Everybody wants to be bigger or better or make money in some form or fashion. But there has been no financial or economically vetted way of measuring these disparate ventures. Uh, Litecoin versus Ripple versus Bitcoin versus Veritaseum versus Ethereum. Which one is sustainable? Which one isn't? If you go to CoinMarketCap.com, I think there's roughly 550 altcoins. A lot of them have lost significantly all their value. Anybody who would have invested in them could have lost a lot of money, probably did lose a lot of money. Okay, using my model, what my model does, it doesn't consider the tokens actual investments. I want to make it very clear. I don't want this to be an SEC issue. It considers the tokens to be a manifestation of the economic effort and capability of the entity issuing them. So the chances are, if you have an entity that has very little diversity in management, low capitalization, lesser skilled developers, or bad business practices, chances are the token that it issues will lose value significantly over time. Conversely, if you had an entity that had significant diversity in management, managerial experience, strong development staff, a strong financial staff, a financial engineering component, then you probably have a token issue that will do relatively well, in relation to those that didn't do well. So I created a model, and it's a model based upon, standard discounted cash flow, comparables, venture capital models that compare the business practices of a particular venture. If the business practice of that venture yields significant cash flow or significant revenue growth with controlled expenses, then it would be prudent to assume that that token, that their product, would be able to track that. And there's a decent amount of empirical evidence and studies. If you go do a search on the correlation between revenues and share price, you'd see companies that have significant revenues tend to go up in price. Do a similar search or correlation between quality of product and revenues, quality of product and corporate and enterprise value, you see a positive correlation there. Apple, and I'm not an Apple fan, so this should be double proof. Apple sells significant product, they have significant revenues. Their product has a strong following and it's thought to be a quality product. Okay, those entities that have a product that is thought to be of lower quality also have lower enterprise value and fundamentals. So it's not necessarily a total one-to-one correlation, but it does a lot better than going to CoinMarketCap, closing eyes, and throwing a dart, or saying, I like this company, or I like this particular, not company, I'm sorry. I like this token because I really love the white paper they wrote. White papers are not going to be indicative of how valuable a token is, how well it does, or how low or high it may trade on a particular exchange. So long story short, long story short, I wanted to bring financial discipline to this primarily field.
So by white papers, you mean the technological concept or the quote innovation that the altcoin might bring
right.
Doesn't necessarily mean that it's going to be traded at a high value, even though it's the newest, coolest innovation in crypto, or it's touted as such. Doesn't mean that it's going to be. Okay, well, I like that. I like that concept a lot. Well, I wanted to know, do you want to make any calls on the show live? What about the euro? You got DAX all-time high. Stock markets are extremely high. I mean, I follow the DAX more. That's here in Germany. I mean, when it hit 10,000 last year, I thought, oh, that's going to go down. Then it went to 11,000. Now it's hitting 12,000 sometimes. This is just going up. It's kind of like a pump and dump. There's like dollars getting pumped, and some others are euros getting dumped. So what do you think is going to happen? Any you want to make any calls?
I don't want to make a call. I'm not a here, and my crystal ball batteries died.
Yeah, I know.
Hang out, but I can feel some reality in the situation. Very much like the CoinMarketCap analogy, where you write a white paper. A lot of people that do these participate in these are very, very adept technologically. Okay, but they attempt to do a financial pursuit without the financial engineering. They hire civil software engineers, but hire very, very few or no financial engineers. Well, I think that the central bank is doing something similar. The reason why the DAX is shooting up is because interest rates are shooting down. The reason why interest is shooting down is due to financial manipulation, economic manipulation. interest rates should be going up because the fundamental risk of that area has went up significantly. You have several insolvent, bankrupt countries. Technically not bankrupt, but insolvent. Greece, which has, you know, I don't want to get into Greece, but structurally, Greece is at negative cash flow. Greece isn't the only one, Portugal, etc. So you drive interest rates down, you hit a floor at zero, right? You don't get what you want. What do? You drive interest rates negative. 33% of the sovereign debt issued in the EU, Europe area is negative interest rate. That's absolutely ridiculous. For those who are not well versed in the vernacular, a negative interest rate means I'm going to loan Theo money, okay? But I have to pay Theo to loan him money. He doesn't pay me interest. I have to pay him interest to give him money. Now, how long is that going to last? Exactly how sustainable is that? So you have the essence of an engine crash. It's just that the timing is very difficult. As Benjamin Graham, I think, said, or was it Buffett? Benjamin Graham, you can, the market could stay irrational much longer than a prudent speculator who remains solvent.
Oh, okay, I like that. So we do have a question from Silver Miner. Silver Miner asks, Reggie, you looking at gold at these levels? I mean, I know you said you didn't want to do crystal ball, but yeah, I mean, I'm also tell people that they should, get physical gold, physical silver, just to, it's nice to have some just in case. So, yeah, it is low. What do you think? You have any opinion about gold, silver, or other, I guess, hard commodities?
The I don't trade much in the metals. I do have an off-the-cuff observation. Gold was pumped up significantly a couple of years ago, and then it fell down significantly. Gold is best priced relative to everything else. A lot of people look at gold, say, you know, it's low now, it's high now. The actual number at any given point in time is highly irrelevant from my perspective. Gold is valuable if and when the crash, the engineer crash I discussed, comes to play. Well, then gold will increase relative to the actual currency, but which will drop. Right now, you had the ECB, which is pushing the euro down. It's pushing the euro down artificially because it's trying to export deflation and unemployment to its neighbors, primarily to Japan. For those who don't know, the reason why the ECB's entered into this currency war was because of Japan significantly deflated their yen. When they deflated their yen, they pushed deflation deep into the Eurozone, which is one of their major trading partners. That combined with the fact that the Eurozone, several members of the Eurozone are insolvent to begin with, hurt them, so the Eurozone is basically fighting back. Japan is the inventor of QE, quantitative easing, basically using the central bank's printing capability to buy debt assets from banks to artificially float the company, not the company, the country. The problem is, a lot of people say Japan is successful. If everybody remembers the lost decade, the 90s, we're on our third decade of the lost decade. That's not success. Okay, and most of the risk assets through Japan have been muddling along ever since. Despite the fact it didn't work, guess who's trying it now? The ECB. Now, the US did it as well. It looked good for the US, but again, you have a banking system in the US that will never survive a significant rate rise. If rates were to go up, the banks would, in my opinion, would get crushed if they can't get rid of the stagnant assets on their balance sheet. Now, these stagnant assets have been mispriced legally because we had a rule called mark to market, where the accounting system said, whatever assets are on your balance sheet, you have to price them according to what the market says they're worth. When that happened, most banks were insolvent, so they changed the rules. Instead of telling the banks to get rid of the bad assets or raise more capital, they said we'll just ignore what the market says your balance sheet is priced at. And that's good. It makes the banks look healthier, but in reality, they're still just as sick as they were before. Now, with the low interest rates, banks can't make money because banks make money on interest rate spread. Basically, they borrow money at 1%, they loan it to you at 2%. If you compress the net interest margin, the amount of money that everybody's paying, they can't make money lending. So how do banks make money? They make money by trading. Okay. Now markets get choppy, or they move sideways, or both. banks are usually horrible traders. I understand Goldman and JP Morgan seems like it's a very prestigious job, but if you look at market prices and every time volatility goes up, banks take losses the next quarter. So when you have either high volatility or low volatility, banks don't make much money. They can't make much money lending. So basically, banking business is in trouble. In order for them to make money lending, you have to raise interest rates. So if you raise interest rates, then you crush what's on the balance sheet already. So it might look like QE worked for the United States, but you're not looking at it long term. You're looking at the last couple of years. Now, the United States probably will get bailed out because Europe is either going to blow up or Asia is going to blow up. So it's the last man standing. And we can get out of this because all the capital run from Europe to the U.S. or all the capital run from Asia or China to the U.S. or to Europe. Because out of this triumvirate of China, Greater Asia, the U.S., and Europe, somebody's going to fall. And when they do fall, the capital is going to rush out of there and into the other two. But again, to further that, we still don't have a solution. This is what's called boom bust cycle. Before this, everybody used to make money the old-fashioned way. They work for it over time. They build it up. Now, you turn interest rates down to zero. You push them negative. You push money to one side. A bubble ends up, bubble busts. Money runs away. You do some more financial engineering, some machinations, turn interest rates negative, buy a bunch of junk assets, push interest rates, push risk capital prices up without the value going anywhere. Prices go up, values stay level or go negative. And this type of financial manipulation is unsustainable. Eventually, the booms are going to get so big and the busts are going to get so bad that it'll be permanent and it's going to be rebirthing of the phoenix with new blood. But hopefully that new blood will possibly, potentially be blockchain based. And here we are back to the Veritaseum venture again.
Yeah, that's right. It could be. Oh, we've got one more question from Silver Miner. He asks, do you still see issues with European banks, in particular AIB in Ireland?
Yeah, the economic issues, but they have to be recognized in order for the banks to have a comeuppance. And it appears that those who either regulate or supervise or adjudicate the banks choose not to. And that's the way it is. It's not just Ireland. I just went through the U.S.'s issue as well by repealing the market rule, which is absolutely ridiculous. Let's assume that you had a loan. You bought a house. The house cost $100,000. You took out an $80,000 mortgage. Okay, the house value went down to $1,000, and you lost your job. But you're able to say, hey, my salary's still the same. I understand my job is gone, but my worth is still, $20,000 a year because that's how much I used to make. And everybody has to turn their back. In reality, that whole situation is bankrupt. Okay, the collateral has dropped, the income has dropped, the value of the payer has dropped. But in the new reality, everybody's turning their head, and so everything remains the same. So that's what's happening in Ireland. That's what's happening in most of the Greater Europe area and the periphery area, and it's even happening in the United States, which is supposed to be, the entity that showed everybody how it's done via QE. But when we look historically, how well does QE work? The third decade of the lost decade with Japan.
Okay, great, yeah. And Silver Miner, he's on a roll. What is your view on the Asian Infrastructure Investment Bank?
I don't know a whole lot about that, so I can't.
Okay, great. I'm going to have to look that one up, too. That sounds really interesting. All right, well, Matt or Reggie, do you guys have any final words? We're going to wrap it up. I want to also ask, if people want to find out more details, where do they go?
Okay. You want to take that, Matt?
Sure. I don't have much to add to the conversation other than you can find a lot about our product and our token on Veritaseum.com, and that is Veritaseum.com. There's a lot of material there. If you're particularly interested in our token, there's a part of the nav menu that's dedicated to it called Veritas Intro. You can learn some good stuff there. I think that's about it.
And I'd like to add, if you go to the site and you look to the upper menu, Matt, if you show them, Uh, we have a blog that I try to post to daily. My other previous property before I got into cryptocurrency was Boom Bust blog, and that's where I got known for calling, the European debt prices, banks, Apple, Google, technology, finance and technology are my strengths, and global macro. And I post significant research for free on the blog, everything from the currency wars to the technology and mobile wars to valuing crypto entities to tokens to everything else. So go to the blog. There's plenty of research, plenty of setups to go through. Everybody should be trading with this because it's cheaper, it's safer, it's everything but faster. So if you're a high frequency trader, this is not for you. But if you can wait a few minutes for your trades to settle, everybody should at least give this a try. The amount of research that I give out to incentivize this is more than worth it. You trade anything, and I give research out on all asset classes: stocks, bonds, metals, commodities, energy, everything. So I welcome you to come by, ask me plenty of questions. As you can tell, I like to talk, and look to see you.
Okay,
And buy
great.
beverages. Don't forget.
Yeah, of course. We do have. I will entertain it if you guys have time. I have time. We do have one more question from another viewer. Greg McAdoo asks, "Hi Reggie. Another point in regard what you were just discussing. The Fed is still paying interest on excess reserves for the TBTF banks. Add this to ZIRP, and the banks can't make any money lending." Do you have any comments to that, or should I?
Yeah, the nomenclature that's passed through the media that QE is ended is nonsense. The banks are still on life support. Uh, as I said, the government, the Fed cannot, or the banks cannot afford for rates to be raised. If you think about it, if you look at the promises, there's been promises or offers or warnings that rates would be raised for years now. And every time they say we're going to raise rates or we're not going to do it, let's look forward. Once you have rates raised, it makes the net interest margin go negative. Okay, and banks can't handle it. And there's not much demand for high interest loans or higher interest loans unless economic activity increases. Okay, employment hasn't increased significantly from an economic perspective. More people may be getting hired, but if they're getting hired at lower salaries, or full-time people becoming part-time, or you continue on, or you do the BLS calculation, where the numbers change, the methodology changes to suit a particular outcome versus actually calculating the empirical numbers. It shows that you don't really have a true recovery. You have financial engineering. Okay, without an economic recovery, you just can't raise rates. Now, with a true economic recovery, rates have to go up. Okay, but it's not going to happen. That's why you have rates. Mr. McAdoo is absolutely right. He's on point. As a matter of fact, if you go through all the other life support systems that banks were giving, you find a lot of them are still on it. The ZIRP policy is pure corporate welfare for banks, pure, plain and simple. And what they're doing is they're taking money out of you and your grandma's pocket because now when you save money, you're getting what? 25 basis points on your money. Okay? Factor in the small amount of inflation you have, factor in taxes, factor in risk, you probably have a negative return. It's not very hard to break 25 basis points. You likely have a negative return. Guaranteed if you put your money in the bank.
Yep, that's right. Guarantee. All right. I want to thank everyone that asked question, and Silver Miner just sent me a link. I'll check that out. Thanks a lot. And I want to thank everyone for watching transmission number 30. Also want to remind you to thumbs up, comment this video, share it with your friends, and subscribe to the channel, worldcryptonetwork.com. Also in the description is my Twitter handle and donations for Bitcoin and Litecoin. Also, Reggie, I put your Twitter in there and a link to your website. So thanks a lot for watching, and that was transmission number 30.